Hey Gunnar.
Hello there. You're in your recording studio on four wheels again.
That's right.
No, that's good. It's got good sound and
Great
very
acoustics.
very little echo. So, how thrilled are you that we seem to have caused a little bit of a change at the EPA? Because I don't know if it was us or not, but at least
Yep.
the announcement has been made now that was formerly only made to the auditors, and it turns out to only some of the auditors
Yeah.
about the NEMP, the National Environmental Management Plan for PFAS, for the
Yeah.
famous forever chemicals.
Mm.
So it has now been the announcement has been made so that it's in the process of being rolled out.
Yeah.
Brilliant. It's on the EPA's website, and even last night I got an email from the EPA to an email address that I use to subscribe to mailing lists. And
Yeah.
I never get anything from the EPA on I have subscribed to all of them. I'm sure I have.
Yeah.
Last night it came in. So very good. I'm proud. I'm happy.
Yeah. Let's take the credit, I reckon.
Yeah, that's right.
Let's claim it.
It's all it's all us. Hey, when is someone gonna nominate us for one of these industry awards? I mean, I don't want to do it myself. That's kind of cheesy.
That's a good. I don't know. Don't know. Is Oscar season coming up? You're like, where's my nomination?
I don't know. I don't know. I guess it's bad form to write your own Wikipedia page. So it would be bad form to nominate ourselves.
That's all right. We'll keep plugging away, and maybe if somebody likes what we do, then something will happen. Who knows?
Yeah. So today is going to be really cool because
Mm.
I don't know Paul very well.
Yeah.
I asked an accountant friend of mine. In fact, I have two, and both of them work for Ernst and Young. And I said, "Hey guys, can you come on and we talk about electric vehicles and what tax breaks are available for them?" And they say, "Whoa, no, 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 no. There's no way we can talk on a podcast from we work for EY." I'm like, "Well, why?"
Mm.
But it's not that you're not going to be bad mouthing them, but it's just like, no way. There's not a hope in hell. All right. But one of them suggested his friend Paul. So I
Nice.
contacted Paul and
Yeah. So did you work with Paul when you were in the process of buying your EV?
no, that was my accountant.
Right.
Um, it all happened that yeah, I finally hit the button on buying for 10 years I've been wanting a Tesla, right? And
Hmm.
so I call my accountant and say, how do I do this best, right?
Yeah.
Do I buy it in my company name?
Hmm.
Do I take out a lease? Do I take a loan? Do I pay cash?
Yeah.
Do I pay it privately?
Yeah.
How does all this affect with my credit if I take I had questions about all this, right? And so then he started explaining to me how this all works, and I couldn't really. That one phone call saved me, I don't know,
Yeah.
tens of
Yeah.
thousands of dollars, right?
Yeah. It's one of these things where, it's like you don't know what you don't know. And I only recently started dabbling into a little bit of this and haven't quite made the leap yet, but I do intend to at some point in the near future.
Like there's no,
Um, yeah, and so
there's not,
I
it's not
kind of
even a
started
question. Everything's gonna be electric. Like no matter how much everybody screams and how much everybody whinges, it's gonna be. They are
100%.
so much nicer to drive in every
Oh,
regard. They're cheaper to drive. They're more economical. They're quiet. They have better
yeah.
performance. They
Oh,
are.
yeah.
You don't pay any services. Everything about these cars is better. It's just there is an industry hanging on to for dear life, and they come up with marketing terms like range anxiety and marketing
Yep.
terms like a hybrid is the best of both worlds, and it is bullshit.
Yeah.
It's the worst of both worlds. You have a combustion engine that needs maintenance,
Yeah.
needs oil, needs petrol,
That's
and you
it.
have an electric train with batteries that you're lugging around that can also fail with a lot of software.
Mm,
You have hybrids are the worst of both worlds. Don't let anyone tell you anything different.
totally. No, no, I'm with you 100%. And like, yeah, I'm not like a gearhead kind of, person who's clinging on to the old school type of vehicle. But yeah, it is funny all the marketing stuff, all you sort of the propaganda stuff that I still remember that phrase. It was like one of the previous prime ministers, I think it was, the death of the weekend. The EV was going to be the death of the weekend. Have your weekends died since you got your Tesla, Gunnar? Or
Yeah.
are you living it up still?
Yeah, it ruins the Aussie weekend, he said, right? And, yeah, of course, the online
That was a good one.
the online community immediately jumped on that. Somebody registered ruinedaussieweekend.com.au, something
Oh,
like that,
really?
and everybody posted
Oh,
there.
man.
Look, Paul is waiting for us, so let's go here. Okay, are you ready?
Ready.
Here we are, Paul.
Hello, Gunnar.
How are you, Paul? Paul, I introduce you to my friend, boss, and co-host James here.
Hey, Paul.
Hi, James. How are you?
Good, thanks. I'm in my mobile recording studio. Don't mind me.
It looks very mobile.
It is.
It's not an EV though. It's not an EV. That's I need your help.
Yeah, well, hopefully you get some tips today and you can restructure it and get the benefits of that.
Oh, love it. Sounds good to me.
So I was online with James here for a few minutes, and I told him that I was talking to our mutual friend Peter, and there's just no way that he can come on a podcast like this. So you are ex-EY, is that
Yeah.
correct?
No, Pete and I worked together in another firm, PricewaterhouseCoopers,
Same thing.
before Pete moved across. Yeah, similar firm, and so we worked together for a number of years. But I think the firms are a little bit reluctant for their staff to speak in public arenas. For what reason? They're very cautious, I think. Yeah.
They allow Peter to talk to his high-flying clients. I know that.
Yeah. That's right. That's right. They want him to talk to them more.
So he said, but look, I can't talk to you on online, but I got someone to talk to you. And that was, as I'm preparing for this, I'm thinking, so there's going to be a former public servant, an engineer, and an accountant talking. So this is set to be riveting podcasting stuff. We're going to have a party here.
Sounds like the start of a joke. I'm waiting for the punchline.
Like the beginning of a bad joke. And you're like, man,
Yeah.
there's two engineers and an accountant talking on a podcast. This is going to be, people are going to flock to this.
You'd think so, wouldn't you? It could break your records.
There's not many records to break here. So you are an accountant.
Yeah, I am. My specialty is in tax. When I worked with Pete at that firm, I was in the corporate tax space.
Mhm.
Since branching out, I've been doing a mix of corporate tax work, small business work, individual work, and other work that I never would have got involved in the past. And that includes doing fringe benefits tax returns at the firms. You have specialist teams that
Yeah.
run those divisions. And so we would only focus on income tax and indeed only a specialist area of income tax. And Pete and I were
Yeah.
in the mining group. You just wouldn't touch other areas. And so when I then moved into the education area. And so I had to learn a little bit about FBT to teach it to the people coming through the ranks. And since then, of course, with my own clients, dealing with fringe benefits tax as well. But it's interesting. What blows me away is the number of small business clients that I see that have never lodged a fringe benefits tax return. Now, it's nigh on impossible not to have provided taxable fringe benefits to your employees. Almost impossible.
Can I jump in with a question first, Paul, before we get stuck into it? Can you just explain fringe benefit tax and kind of what it is and the sort of stuff it normally relates to?
Right. So fringe benefits tax was introduced in 1986. And basically it's saying where you as an employer provide a benefit to your employees as defined, we will refer to that as a fringe benefit, and the employer should pay tax on the fringe benefit. And what it's really getting at, it's a tax that's inefficient in its application, but efficient in its anti-avoidance process. What do I mean by that? If you didn't have it prior to 1986, you'd dress up all of your salary packaging by way of benefits. You'd say, hey, why don't we not pay you 50 grand a year and instead we'll give you a car? Why don't we pay for your kids' school fees? Why don't we pay your rent? Why don't we pay for all of your personal expenses?
Yeah.
which are not subject to tax, and we'll tax it that way. Now, there was, a former provision in the Income Tax Act that would do it, but it didn't do it well.
Yeah.
And so here we have a prescriptive act that defines how you value those benefits, and guess what? We'll tax it at the top marginal rate.
Yes.
So it's an anti-avoidance measure in some
That's
ways, in that it says, don't do it, or we'll tax you at
yeah.
47%.
That's a really important thing, and as a small business owner who hadn't dealt with FBT too much until maybe recent years, when you start talking about packaged vehicles and that sort of thing, not non-EVs, it adds up really quickly. And yeah, you realize that it's taxed at that sort of 40, 45, 40, 47% bracket,
Not
and
only
it
not
adds up
only at
really quick.
47%, they gross it up
Yeah.
cleverly. Treasury think
Yes.
of everything, and so they gross it up to factor in, one, the deductibility of the fringe benefits tax itself,
Yeah.
as well as the deductibility of the item, which would not otherwise have been deductible for the employee.
Yeah.
And they factor in that you would have got GST input tax credits. So we'll multiply the benefits value by 2.0802 or whatever.
All right.
Basically double it.
Oh,
Yeah.
settle here,
Yeah.
right? Because you completely lost me here already, right? And I thought I knew about this. So hang on. When a company comes along and says, "Hey, you know what, Gunnar? Instead of giving you a pay rise, why don't we give you the use of a company car?"
Yeah.
That sounds like a great idea, because then I don't have to pay for the car, and the company pays for the car with pre-tax money. So they pay out of that's a company expense.
Yes.
And they don't have to pay company tax on it. Okay, that's brilliant. And the ATO misses out, because whatever, say $20,000 is the cost of that car per year or whatever it is, right? Somebody would have had I spent this money, I would have had to earn, let's make it round, $40,000. 20,000 go into tax and benefits and all sorts of stuff. Then I have 20,000 in my hand that I can spend. And so if the company pays for $20,000 for this car pre-tax, then then nobody pays tax on this. And then the government comes along and says, "Hang on a second here, Gunnar gets a company car. That is a benefit to him. As a result of that, someone's got to pay the tax here." Okay, yeah. And that's how the fringe benefits tax came in, where they say, "Oh yeah, we don't really care here, right? But if Gunnar doesn't pay it, dear employer, you do.
You pay it. That's right."
And the employer will then, of course, come along and say, "Hang on a second, suddenly this doesn't add up anymore here." So they then go back and charge me. Is that roughly what's happening?
That's totally right. And they level the playing field by factoring in what would now be a deductible expense for the employer, gross it up to get the net same outcome that would have happened had you paid them the salary anyway.
Yes. So you guys, sorry.
And we'll get you at the top marginal rate.
So you just said, Gunnar, paid by you, but let me just confirm, Paul. So FBT, I mean, it is paid by the company, right? By the organization, not the individual.
By the employer. In most cases, you have a corporate structure, so by the company is the language that you use. Yes, the employer would oftentimes be a company. Yes, they pay it, not the recipient.
Yeah.
Now, that's great. If you're the employer, you say, "Right, you pay it," but of course the employer says, no, I'm going to equalise this.
To use a real world example, kind of to your example, Gunnar, where, you're providing, if I as a company and employer are providing a vehicle to an employee as part of their package, and the expense value of that vehicle per year is $20,000. You also have to factor in the FBT, which could be, say, hypothetically $10,000. So the total value to that employee's package is actually $30,000.
That's right.
Not 20. So it's a lesson I've learned the hard way. Unfortunately, like many lessons I've learned, that you have to factor in FBT and calculate it properly to know really what the package impact is. Because as an employer, if you're not including it, you're losing leverage in a negotiation around salary. and
I see the
packaging.
trick, however, is this is it. Most people don't realize that. They say, "Oh, the company gives me a car and I don't pay for it."
Mm-hmm.
Oh, yeah. Yes, you do,
Yeah.
because the company pays the fringe benefits tax, and they're generally not a charity. So they say, "Look, I mean, I had to pay fringe benefits tax on your behalf, and they're going to deduct that from your pay package."
So,
And
so, so, Paul, you said, you're coming across companies that have never lodged an FBT return. A crazy tax year for FBT, by the way, just to make it hard. It's March to April or something, isn't it?
It's 1 April through to 31 March each year. And the
Yeah,
logic behind
crazy.
that when they brought it in, and a shout out to the great Hawke and Keating government of the 80s, they brought in so many measures in this period of time, but they thought about it really well. And they
Mm.
said, well, you're so busy in certain periods that we'll make this a period outside of your busy compliance period.
Uh-huh.
So March is suitable, done in time for your June tax year, all sorted. So I think having a different year is wise from a compliance load perspective.
I was just going to say, what other sort of things that tend to attract FBT? Like, what sort of
yeah,
benefits are we talking that companies might not ordinarily think of and may not think they need to lodge returns?
Yeah, the obvious big one is expense payment fringe benefits, and you say, well, why is the company paying expenses on behalf of the client of the employee? The most common example is your particularly sales staff. They take clients out to dinner, and it goes to, depending on where you account for it in your accounts or your accounting software, it might go to business entertainment or an entertainment account or a dining expenses. Sometimes it's hidden away in various accounts.
Mm.
But that expense, and you say, yes, but we were taking clients out. Well, that doesn't matter. That is subject to fringe benefits tax,
Mm.
right? But keep in mind that the client portion, of course, they are not employees. And so you shouldn't pay fringe benefits tax on their portion, but you should pay fringe benefits tax on the employee portion. It
Mm.
could be tickets to the races, to the Grand Prix, to the tennis, to the circus, to a show. All of those entertainment type costs will be subject to fringe benefits tax, and people just miss it. They just think, oh, well,
Mm.
no, that's just we said it was non-deductible, and say, yes, but there's more to it than that.
Yeah.
James, careful. I know you have a very generous policy that when we are out in the field,
Yeah.
you pay for lunches on our
Yes.
credit cards, on our corporate credit cards.
Mm-hmm.
We don't clock up hundreds of thousands of dollars a year on the McDonald's in Rudy Hill, but
Yeah.
these are things that you need to watch out for as
Mm.
the business owner. Laptops, how are laptops handled these days, Paul?
So a laptop so you see the way that the Fringe Benefits Tax Act is structured is it has various subdivisions dealing with different types of benefits, and then there are provisions for exempt benefits. There's an exemption for one laptop a year. And so laptops you can provide to employees and get an exemption for one per year, similar to phones and other devices.
Mm.
Mm.
So here, let's go to the cars, because that's ultimately what we want to talk about. If I as a business owner, for example, I buy a company car, and I then, of course, I'm going to pick up the kids from school now and then with this car. Officially, what needs to happen, I need to keep a log for X months. I don't know what it is anymore. And I in this logbook, and I say I was driving $20,000 a year, and 10,000 of those were private, and 10,000 of those were properly business related.
Yeah.
All right. So the tax office then comes along and says, okay, fair enough. Car, whatever the costs of that car were, including depreciation, service, petrol, blah blah, right? Half of that your company can pay, and the other half is de facto an income to you, to me in this case, and you have to pay income tax on it, which is basically the fringe benefits tax. Is that roughly how this works?
There's a little bit of a trick to that, and it's one of the interesting things. And I think the way that people so often, I have new clients come to me and say, "Oh, my car is deductible." I say, "Well, why do you think that?" And there's a lot of confusion around what is deductible travel. There's a series of cases dealing with this. And people get confused with what is deductible travel. And I've got some really serious views. And I think the ATO is very lenient on their views because the three key cases, really, but there's two key ones in particular. Lunny's case, and I think it's 1940s case, says home to work travel, not deductible. Then there was a case, Payne's case, in or around about 2012. This fellow using helicopters to fly to the airport for his job as a pilot. He was claiming deductions for his home to work travel because he had a deer farm at home. They decided, because it was always the ATO practice to say, well, work to work travel is deductible. Right?
Uh-huh.
Now I don't necessarily agree with that because I think following Lunny's case, work to work travel is not deductible. Everyone will shout me down on that, but anyway, that's what I think. But so Payne's case said, well, that's not deductible. The ATO then changed the law to say explicitly work to work travel is deductible unless one of the places is your home. So you've got all these issues around whether it's deductible or not. But as you say, Gunnar, you're saying don't worry about the technicalities. Let's assume that that it legitimately is 50% deductible travel. I've kept my logbook. Well, what you then have is two different methods for determining the value for fringe benefits purposes because there's a very simple statutory formula. And this statutory formula says, look, take the base value of the car, i.e. what you paid for it, including GST, and let's say that's $100,000, just for easy numbers. 20% of that is your taxable value for fringe benefits tax. So $20,000 per year is your taxable value. Keep in mind, you've got to gross that up by 2.08. So really the taxable value is $40,000.
Yes.
Then apply the fringe benefits tax at 47%, so around about $20,000 a year, right? Roughly. So there's no factoring in at all of your business use under that method. Now, then there's another method called the operating cost method. And the operating cost method, instead of just going 20% of your base cost, it says take your deemed depreciation, deemed interest costs, fuel, repairs, rego, oil, all of those costs, but apply a business percentage or take away your business percentage to get your private percentage. So you could use that method and say all of your costs added up to, as you pointed out, 20,000 and 50% was private, then 50% of the total cost, $10,000, subject to fringe benefits tax, gross it up by the factor of about 20,000, pay fringe benefits tax of around about 10,000. So you'd have to use the operating cost method to get any benefit there.
Yep. That is something that people are not aware of because it disappears in the payslip somewhere if that happens, or if you're the business owner, it somehow gets lost in the wash. But that company car, that pickup that school pickup costs a significant amount of money if you use your company ute. People don't understand that. Now, Paul, we want to buy a car. So there's several ways of going about this. So I could, for example, if you're frugal enough and lucky enough, you can pay cash for it, then there's no issue here. But you can either take a car loan or you can lease a car. Tell me the difference between the two of them.
Yeah, I mean, it's just a financing option, really, when it comes down to the financing. One is that you pay up front so that you're not incurring any interest costs.
Yeah.
Then there's a number of ways you can finance it. You can buy it outright and make repayments on the loan. And for my clients, I often recommend that. Why do I say that? Because in the long run, you're probably better off. And you might say, but that's strange because all the leasing companies advertise these low rates. Yeah, they do. That's their headline rate. But what they don't add into that, I'm being a bit nasty here to them, is they don't include all these little add-on administrative fees. For example, every month they clip you $3.50 for the processing fee. Well, that should be included in the total cost of the finance. The bank doesn't charge you that when you're repaying every month. So these things are little tricks. And so really the rate that you're paying in interest on a standard leasing arrangement is closer to sort of 8 to 12%. Whilst the advertised rate might be 5 or 6, and you think, gee, isn't that great? That's better than my home loan rate. there's more to it than that.
Mm-hmm.
And there's an upfront admin cost. So there's those costs. And then on a lease arrangement, there's really two key types of leasing arrangements. One is basically a hire purchase, and that is we make set repayments every month.
Yeah.
And at the end of the lease term, we have either an automatic final payment to take legal ownership of the vehicle.
So that's a balloon. That's the balloon payment at the end of it, right?
Yeah, exactly.
So you make payments for, I don't know, how long are these leases? 3 years, 5 years?
Normally 3 years.
3 years.
Get them 5.
So you make 3 years. Every month you make a payment, and at the end, the car is not yours. The car is never yours until the very, very end. The ownership stays with the lease company.
Correct.
But right at the end, so after 3 years, you're not done. The lease company will come along and say, hey, you still owe me. And these balloon payments are not insignificant, right? So
no, they're not.
I don't know, $50,000 classic car, right? But you could easily end up with a $30,000 balloon.
It's a real trick there, Gunnar, because, I've got clients who come to me, and one of them in particular, I hope he doesn't listen because you'll know I'm talking about him, but every time he'd go in and get his car serviced, I reckon they'd rub their hands and go, watch this, and have a love of it. He'd walk out with a new Ford Ranger every time. And he'd call me and he'd say, I bought a new Ranger. And I'd say, why'd you do that? He said, you won't believe it. I've got the new model. It cost me less every month than the old one.
Yeah.
But then you look at the terms, the old one was on a 3-year deal. This one's on a 5-year deal, and his balloon payment's about 3 times as much. And you think, of course they're less. You've got to be joking me. So just going back to that point, one of the key ways you can do it is basically a hire purchase arrangement, or what we'd call a finance lease. Historically, we'd call it a finance lease. You get the option to own that vehicle at the end of the lease term by making the balloon payment. The other way you could do this is what we'd call an operating lease. And in an operating lease, there's no defined option to buy the vehicle at the end of the lease term. So you might enter a 3-year lease term, payments every month, but there's no specific option in the agreement to take ownership. Now, the reason that's important, the tax depreciation provisions in the Act rely on the term as to whether or not you hold the asset. And so there's concepts of economic ownership. If there is an option to purchase, you will own the asset and depreciate it. Therefore, you'd claim the depreciation deductions and interest. But if there's not an option, you might have a wink and a handshake agreement or a gentleman's agreement that we'll negotiate that later, and there is indeed no option, then you don't claim depreciation. Rather, you claim it's a rental agreement. You claim full deductions for every payment that you make. And that's better from a net after-tax outflow because you're getting full deductions for your full payments.
Understand.
And so they'll have that. So that'll be the operating lease arrangement. And then you complicate this by adding in these novated lease arrangements.
So let me say this. To clarify things, am I right that when you lease a car, no matter in which way you go about it, you never own the car unless you paid it out at the end, but the ownership vests with the lease company. So you're basically driving a rental car.
Exactly. The legal ownership stays with the finance company until such time as you meet the requirements of taking over ownership, i.e. the balloon payment. Okay.
And Fringe Benefits applies whether you lease it or you don't, because Fringe Benefits is a fringe benefit. You have to pay tax. Now, whether you pay this when you pay cash in one go or when you over the lease payments, but ultimately the Fringe Benefits, if you partially use this car privately, you're going to be hit with a Fringe Benefits tax. Not inconsequential. Not inconsequential.
No, absolutely. And it's also, it doesn't matter even if you use it, it's available for private use.
Yeah. So careful, ladies and gentlemen out there, and know us engineers, we think we got this all covered because we know how to open Excel. Be careful with this stuff. That's all I'm saying.
These rules are tricky. Like great how you're explaining it, Paul, because you're explaining it in a really clear and concise way. But it's taken me a long time to get my head around this. Then they are complicated frameworks that we're talking about here.
They really are, and it's a tricky one too. I mean, one of the examples on that, and I've got clients with, I don't know why, but Range Rovers seem very common. The Range Rover will cost.
They drive very well to the workshop and back.
Yeah.
Yeah. And only there. The Range Rovers, I think they cost sort of 150 to 200 grand.
Yeah.
Right. So you're paying fringe benefits tax on the $200,000 value, right?
Mm-hmm.
And I'll just use that as an example. And you go, okay, $200,000 uplifted by the gross up rate, 400,000. You then go, if we turn that over, a couple of hundred a year, and you're like, but I'm only getting a tax deduction for depreciation at the depreciation limit of $69,000.
Mm-hmm.
So I'm only getting a deduction for 69, but I'm paying fringe benefits tax each year of this massive amount. I just think it's a crazy structure to put those cars in your business. It's just silly.
Yeah, and it's like you need either very good advice, which clearly you give to your clients, or a very deep understanding of this in order to do these things strategically, because it's painful when you find out after the fact that you've made a wrong decision or you structured something the wrong way. Like, it's really painful. But like the flip side is that it's difficult to get the right advice and know well enough to strategically do this stuff. So the service you provide your clients in doing that, Paul, is actually very, very valuable.
Well, it's funny you say that, James. They don't find it valuable when I take them on as new clients because they say, well, we've never done this in the past. I said, well, you better do it now because it's coming. And, what recent one, they had 2 Range Rovers, one for the father and one for the son in there, and they got an awful fringe benefits tax bill, and the son was in the process of buying an Aston Martin and putting it in. I said, hey, get that into your own name. This is a disaster.
Yeah. Geez, I mean, better finding out from you than finding out from the ATO, that's for sure.
Well, precisely, James, because then what you do is you add in shortfall penalties and interest. It's a debacle.
You mentioned the gross up value of 2.08. Please explain that to me.
What it's factoring in, Gunnar, is saying if the individual employee were to pay for this benefit of their own account, they would not get a tax deduction for the cost. And they would not, as a general rule, be entitled to GST input tax credits. If the company pays for these benefits as part of the salary package, then they would get the deduction and they would get the input tax credits. So we factor that in. So instead of it being, in my example, the $200,000 Range Rover, apply your 20% deeming use, so bring that to $40,000 of value, gross it up by the 2.08 to factor in deductibility and GST. So we get it up to $80,000. Yes. Apply the 47% tax rate to get it to $40,000 a year. Yeah. I mean, it's a terrible outcome, but it's factoring in, it's equalising the result that would have happened had you paid the salary and paid for the car yourself.
Yeah, had you paid tax on your income, because if you want to buy a $200,000 car, you have to earn $400,000 to do that. That's the thing.
You nailed it.
Right?
You nailed it.
And that's also, most employees never think about that, right?
Yeah.
Only when you are a business owner, suddenly there are options that you pay things with money that you have paid tax on and some that you haven't. Yeah. As an employee, you only get money in your hand that has already been taxed. Mm-hmm. So electric vehicles and fringe benefits tax. So there is, when I found out about this, I couldn't jump fast enough onto the Tesla website. Tell me more about this. It's a license to print money if you're a business owner or you have an ABN.
There's no question. I always say to my clients, because everyone wants to know about tricks in the tax system, and I think people believe that the rich out there have all these structures that get them these fancy tax results. It's not true. There's always something to catch the cheeky ideas. And everyone suggests to me all these ideas. And I say, yes, that's great, but there's this provision that stops you from doing that. There's 3 tricks in the tax system that I always say to people. One is your home offset account. You're not taxed on the savings in your interest outgoings. Right? That's such a smart. You're basically doubling your pre-tax return.
So sorry, offset accounts for home loans. It's just in case
offset accounts for home loans.
Offset. What? Yeah. Explain. So you have a home loan that you owe. Let's make it this easy. You owe the bank
$500,000.
$500,000. Let's make this easy, right? You own, But somehow you manage to get to scrape $100,000 together. So you can now, with these $100,000, you can do a lot of things. One of them is you can buy a car. No. One of them is
Yeah.
Not tax advice. Not tax advice.
Yeah, you can buy
General advice only.
a quarter of a Range Rover, right? No. So you can put this into a bank account. In that bank account, you get, I don't know, how much do you get these days? I don't know the interest rates.
Probably 3%.
3%. Yeah, 3 or 4%.
3%
and
on
paid tax on it.
And there it comes. So you put this into the bank. You get $3,000 a year because it's $100,000 in the bank. 3% gives you $3,000 a year.
1,500 of it.
And you lose 1,500 of it immediately because it's income. You have to pay tax on this, right?
Mm-hmm.
So your net benefit is 1,500.
That's right.
Yep.
While your home loan is sitting at 6 or 7%. Right. Now, if you put those $100,000 into what's called an offset account, then suddenly you only pay interest. Your home loan is $500,000. You put the $100,000 into the offset account where it stays and it is at any given time readily available to you, but it is offset against your home loan. So your home loan only pay interest for the time that $100,000 is in the offset account. You only pay interest on $400,000.
Yeah, you've saved yourself $6,000. Yeah.
So you are saving yourself $6,000 and you don't have to pay tax on it.
But it's not taxable. The savings is not taxable. So it's a 47% marginal tax rate. It's the equivalent of a pre-tax return of 12%. You cannot beat that anywhere because it's a guaranteed pre-tax return. You cannot beat that. That is the first trick in the tax system.
Yeah, that's a great tip.
The second trick in the tax system is superannuation. And in particular, making your maximum concessional contributions every year. You've got $30,000 a year, but there's an added trick to that in that if your superannuation balance at the start of the year is less than $500,000, which a lot of people it is, and in prior years you haven't contributed up to your concessional cap, you can go back 5 years and catch up and get a tax deduction for it. Wow. And if you're on the top marginal rate, your tax deduction is at 47%. Put in 30,000, basically get 15,000 back.
Yeah.
Right. So you've put in 30,000, but you've put in net 15 thereabouts, $15,000. Your super fund received 30, but they're taxed at 15%. So you've really got 85% of that value. So, but your net left over in the super fund of the 30,000 is 25,500. You've paid 15,000 to get 25 into your super fund, and it's taxed in a 15% environment. By the way, if you've got carry forward concessional contributions, you might have $100,000 of this to do.
Yep.
Now you have to be careful. This effective tax rate might not be 47%; it might be 30%, but it's still a benefit.
Yeah.
And you have to be careful of what we call Division 293 tax. Whereas if your earnings plus super contributions exceed $250,000, they will clip you an extra 15%. But it's still a benefit.
That sounds like a fairly case-by-case type situation. Is that fair to say, Paul? And so,
yeah, it is, but most people can do it.
Yeah, but something you'd have to and I mean now, I mean, what is it? We're recording this in early June, so I mean now is probably a good time to get advice about this before the financial year ends. Yeah,
that is an unbelievable trick. And then your earnings taxed at 15%. That is the best trick in the system.
Yeah,
excellent.
Yeah.
So that's the second trick. The third trick is electric vehicles. And when I say the three tricks, people go, "What? What do you mean?"
Yay, we're talking EVs.
Wow. Yeah. Look, when they brought this in July 2022, you know, this and it is exactly its purpose. If you look at the explanatory memorandum to the bill that introduced this provision, it is explained that this is to encourage EVs. This is part of our net zero target. We are promoting electric vehicles, and what a great way to do it.
Yep.
Prior to the introduction of this, you've got your $100,000 vehicle. You pay fringe benefits tax at the 20% deemed value, gross it up, $40,000, basically $20,000 a year.
Yes.
Guess what? We're going to put an exemption in, so forget about paying your $20,000 a year in FBT. Now, my number there is a little bit inflated because, of course, as we'll get to, the cost of the vehicle can't be more than the luxury car limit, which is for the 24, 25 year, $91,387. But basically they're saying get an electric vehicle that qualifies as a zero or low emission vehicle, and we will include an exemption in the Fringe Benefits Tax Act. You don't have to pay fringe benefits tax on them.
It's huge.
Provided you meet certain conditions.
That is so massive. That is so massive.
It's huge.
I had to take a double take when I talked to my accountant about this. Right? He's like, hey, hang on a second. That means if I buy this I longed for the Tesla since 2013. When I buy this car in my company name, not only do I get immediately 10% of the GST back, right? Because I buy it in the company name. I get
a tax deduction.
I get immediately 10% back. In the next pass, I have 10% of my vehicle back. That's the first thing that happens. And the second one, if I pay for that car, I will not have to have any logbook. I can pick up the kids from school. They're not going to school anymore. Hence, I could afford it. But family can drive this car. We don't have to take
100% private use. You don't have to use it. 100% private use.
None of this, and it all comes. And here's the kicker: I pay with this money out of my company before I have paid tax on it, or even better, before I have paid me a salary. And that takes another 40%. So I got 10% back, and I got another 47% because I don't pay tax on this money. I tell you what, I was on the Tesla website so quickly. I got myself. I found a. I couldn't go for the performance one. Never mind. I found a slightly used one from Tesla. It was a floor model, and it was there for $50,000. I clicked, this is mine. In the next pass, I got $5,000 in GST back.
Yep.
Yeah.
And I saved myself 47% of that car because I don't pay tax on that money. That Tesla that's standing in my garage cost me $25,000.
Totally. And the other thing with it is back in the first year, because you had the instant asset write-off, up to 150,000 back then. And so you could deduct up to the luxury car limit of $68,000 at the time. You deduct the full $68,000. And if you bought one for less than 68, you deduct the full cost in year one.
Yeah.
Now you can't do that now.
But I even yes, not only did I could pay cash for it, but I also paid with my Amex card, so I got 75,000 points. That's another tax.
Now you've opened a can of worms that we're going to have to come back to. Let's put a little pin in that, and let's come back to that one.
Is that a triple dip, Gunnar? That's the triple dip?
No, it's a problem. It's a problem. Let's come back to that one.
Okay.
I like what you're doing, but
oh boy, damn it. Okay, I can cut this out at any given time.
cut it out for sure. Yeah.
So that is what this podcast was all about. I swear, Paul, I was over at a friend's place 2 months ago, and he told me, Gunnar, guess what? I ordered the new Model Y. And he was umming and ahhing with the Elon Musk thing, and he said, I bought the Model Y, and I said, you do buy that in your company name? He said, no, I actually don't want to muck around with all this. I'm like, oh, yes, you do.
Yeah, you do.
Yes, you do. The guy, we are over there the other day, and he says, I owe you $40,000. And I'm like, yeah, I know.
Oh, totally.
Yeah.
No, I hope he had a nice bottle of wine there for you.
I think, because people would have been, anyone who's dealt with FBT in the past, it probably would be like, I just don't want to deal with this. It's a headache. It's expensive. And if you're not aware of this exemption that's been put there to promote the purchase of EVs, and I think if this podcast does nothing else other than gets, more exposure to a handful of people that this exists, because it was probably well publicized at the time, I imagine, but it's not something that unless you go looking for it, you're not going to find it.
In the tax world it was, but outside of that, how do you know about it? I think, and to that point, James, I would tell my clients, don't put a car in the company. It costs you more than it's worth, and just avoid fringe benefits at all costs. Don't bother with it. There's some that you have to deal with because it's entertainment and costs of taking clients out, but avoid at all costs. But I think
Yeah.
there's some important points to raise on what a zero or low emission vehicle is, because it has to be either a battery car,
Yeah.
a hydrogen car, or prior to 1 April 25, i.e., too late now, a
Hmm.
plug-in hybrid.
Yeah, then
Yeah.
they are
And
out
and
now.
this
They are no longer.
They're out. They're
Yeah.
out unless you had a prior financial commitment for it,
Mm.
i.e., you ordered it before and had an obligation to pay, or you're in a lease that you entered into prior
Yes.
to 1 April 25 and had to keep paying it. Yeah. So
Yeah,
the
we're
Yeah.
too.
plug-in hybrid would still get it then.
Yeah, we're too late
So-
for our listeners now for the plug-in hybrids, but they are bullshit
yeah.
anyway. We talked about that before. Never mind.
Yeah,
Okay.
I think we're all like battery EVs are the way to
Yeah.
go.
Yeah.
And I mean,
Yeah.
you're talking about Tesla, and I mean, yeah, like people's opinions about about the brand is are what they are.
Yeah.
But what I would say is like I've been really quite impressed just at the greater variety that we have and the greater choice that people have for EVs. And say at 91 grand, which is that luxury car tax threshold, you can get a lot of nice EVs under 90 grand.
It's
Hello?
interesting you say that too, James, because I'm going to call them spruikers, and most of them are novated lease companies.
Yeah.
If you jump on their websites, all you have to do is search EV vehicles and
Mm.
FBT, and they actually include pictures of all of the eligible vehicles. It's
Yeah, I've seen
terrific.
that.
Some
Yep.
some have a list, but I prefer the picture. I don't know why.
Yep.
And
Seen
you can
that.
just look through and go, oh, that one qualifies, that one doesn't. Now, this is an
Yeah.
important point. So I'll come back to the novated lease spruikers, but one of my clients who did indeed have a Range Rover in the company, he and his mates got talking about this great EV cars, and so he went to the Tesla dealer. And here's one of the problems with this, James. You raised there that issue of that you don't get the exemption if the car at its purchase cost was above the luxury car limit, 91,387 or whatever the number is.
Yeah.
Now, my friend and client went to the EV dealer, and of course, the dealer is spruiking. He's giving him tax advice. You'll get a full tax deduction. No, you don't. There's no FBT. He's selling him the Model S with all the bells and whistles.
And that's a long time
Sold
ago.
it to
Yeah.
Oh, he
Yeah.
sold it to him for 90 grand. Now, this is before the big price reductions.
Yes.
Yeah.
He sold it to him for 90 grand. He sends me the invoice and says, have a look at this. Haven't I done well? I'm like, oh boy, no, you haven't. So guess what we've got? We've got a 20 grand a year FBT cost.
So anything above the luxury car tax threshold is FBT is payable on it. Is that what
A
it is?
lot on the works. It's not just the portion
Oh,
over and
it's the whole
above the
lot.
limit. It's the whole lot.
Oh, so if you go over, you're over. That's it. There's no exemption for
You're
you.
over. You're out of the exemption and you're into FBT.
Yeah, right.
So shocking result. And don't take tax advice from a car salesman. Don't
Yes.
take any advice from a car salesman.
My favorite EV at the moment, the one I pine after, is it's a Kia, funnily enough, which doesn't sound like that interesting. The Kia EV6, I reckon
Yes.
that is
Yeah.
just
Very nice.
awesome. But the thing is, you got to go for the mid model is below luxury car tax, but the performance model, that high spec dual motor, that's going to be over. So I think in a lot of cases, people will find that the lower and mid end options are going to be below. But there's loads of good options.
But
below 90 grand.
I'm not kidding. There is EVs between. They are now knocking on the $30,000 mark.
Yeah,
and
truly affordable. Yeah,
and dip slightly below that as well.
Yeah.
It's and again, guys, when an EV costs you 60 grand, it's actually 30. Keep that in mind. Okay, after listening to this podcast,
it's outstanding. It's outstanding. You know, one of the clients who interestingly had two Range Rovers and was going to put a Aston Martin in there as well. One of their high-end employees came to them and said, "I want to get an EV. I want to do a salary sacrifice into an EV. I'll get more net."
Mm-hmm.
And surprisingly, the business owner said, "No way, I'm not doing that for you, blah, blah, blah." And we had to talk him round and explain to him, but hang on, you don't lose.
Yes.
We're not saying pay any more. We're saying pay him the same. He just ends up with more in his pocket.
Yeah.
And so we got him through. And isn't it funny? Happy to have the Range Rovers and the Aston Martin in there, but not the EV. I mean, it's crazy. But anyway, we got him there. Model Y Tesla, so he's pretty happy. Just took delivery last week.
Very nice. What's wrong with my Amex?
Maybe take it offline, Gunnar.
I will come
I'll
back to
stop
that,
the recording here.
I will come back to that, Donna, because I want to just highlight, though, that it's not just the cost of the car that's exempt.
Correct.
Registration, insurance, repairs, fuel. And what do I mean by fuel? Electricity. There's a deemed electricity rate on this. No FBT.
4 cents 4 cents per kilometer I can deduct.
That's the one. That's the one. Yeah,
Yes.
So no fringe benefits tax on this if the company pays for it. I mean, this is incredible.
Yeah.
So it goes beyond the cost of the vehicle. One thing I should add in, though, is that when it comes to fringe benefits are reportable. What does that mean? You get your taxable statement for the year that says you earn a couple of $100,000 a year or whatever it is, and then they add in these total remuneration items, reportable superannuation contributions, reportable fringe benefits tax. And so reportable fringe benefits have to be included even when, in this case, the vehicle cost is exempt. Now, you only do it at the lower gross up rate, the 1.88 gross up rate, but you still must include that. And that has an impact for things like determining whether you're subject to Medicare levy, whether for spouse maintenance, child maintenance, these sorts of things. So that's one just to be aware of, that there is still some reporting obligations.
Yes, just because it's exempt doesn't mean you don't have to report it. You don't have to pay it. That's the trick.
Exactly. Yeah. Now let's quickly jump to your Amex. This is a real tricky one. So I've got you wouldn't believe me if I told you the bank fees some of my clients pay because they want the Amex points. Now, it's all great to get the Amex points, but first and foremost, the bank fees they're paying to the spruikers are worth more than the points they're getting. Yes, there's groups. I'm not going to name them, but these groups at Spruker I'm talking $50,000-$60,000 of fees a year. It's ludicrous. So that's point one. It might not be economical to do it, but if you're just managing it yourself and getting the points, terrific. However, when an employee, which you will be, gets the benefit of points from the use of a work card, and they're paying for work expenses, those points are subject to fringe benefits tax. Now, some people argue with me that it's not, but they are subject to FBT. It's a dangerous area.
Wow.
And the spruikers never tell you that.
Yeah.
They say, oh, no, it's not subject to FBT. There's a different pains case dealing with Qantas frequent flyer points.
But hang on, is that for? Say that again, please, because the generally frequent flyer points are not subject to FBT.
Yeah. So there's a distinction here. So frequent flyer points, whereby, for example, because that's pains case, a different pains case to the one we were talking about before, the guy who was flying his chopper he wasn't always flying a chopper, but anyway, it's a different case to that, but another pains case. It was an employee getting frequent flyer miles, and it was held in that case that the frequent flyer points that they generate are not subject to FBT. Okay, well, that's all well. There's a difference there where it's an employee who is not also a director or business owner. I'm very much talking high level here.
Yeah.
Where the issue arises is for parties who are the business owner, and this is a very common structure. A business owner, director, and shareholder of a company will also be an employee, and they'll certainly be an employee for fringe benefits tax purposes, whether they're an employee for pay-as-you-go purposes or not. They'll still be an employee. And in fact, the case just came out last week whereby a group of directors, I think they were brothers, directors of a corporate trustee, where they weren't officially employees of the trust, but they were deemed to be employees for fringe benefits tax purposes, therefore subject. They had all these luxury cars they were using, so they're always going to attract attention. But they became subject to FBT. So bring that back to all these different structures where you're the business owner, director, owner and operating mind of the company or operation, and you're also an employee for fringe benefits tax purposes, which you will be. what you have effectively is that you, by association and arrangement, it's almost like a third party arrangement. The employer, you, entered into an arrangement with the third party, Amex, to get points also for you, the employee. So it's like a particular third party arrangement where you effectively arrange to get the benefit for yourself. And it brought, I'm paraphrasing here around. It's basically for owners and their family. They can get hit with FBT on the frequent flyer points.
Yeah, right.
Now you know, do with this what you will.
Yeah, the first thing I'll do is I'll cut this out of this podcast. That's the first thing I'm
cut
going
this
to do.
out of the podcast. Yeah.
Good call.
Yeah. Or leave it in for interesting comment and listeners' pleasure.
Debate.
But so many people say to me, "Oh no, there's no FBT on that." I'll tread very, very carefully. If it's an employee who has no association with it, go for your life.
No. That would be. I definitely have an association with the company I own and
Yes,
work
that's right.
for.
Yeah,
That's right. Yeah, no, yeah, it's a.
Gunnar, we know we suspect the EPA are listening, and maybe the ATO is listening as well. Gee, right? I hope not. Maybe they are.
Our friends at the EPA,
They might pass it on to their federal colleagues.
I'm gonna pick up the phone right now.
Yeah. And I looked into it very carefully because you get all those offers with Amex. You say if you log in now and get a new Amex and you've never been an Amex card holder in the last however many years, we'll give you 200,000 points or 150 or whatever it is. And so I looked in, I'm like, this is great. I'm going to do this. And I'm like, oh, no. This could be dangerous for me.
At what rate are they taxed, by the way? What's the value associated? What's the value assigned to each point?
Well, that's the question. How do you value it? There's a question of value.
Yeah.
That's a more difficult one.
Yeah.
It's a market valuation exercise.
James, would you like to ask any other free advice while we have Paul on?
Yeah.
Oh no, I won't put you on the spot, Paul. But I mean, what you do just in terms of providing strategic advice is really important, and it's something that I've definitely come to understand just how valuable somebody who can look at what you're doing, like as a business owner, who can look at what you're doing and actually give you some advice about strategic moves you can make. It's just invaluable, mate. So, but look, maybe we talk offline a bit more about this. But that's been great, that explanation you've given us.
Paul, where are you based? I forgot to ask you.
I'm based in Brisbane. I'm very environmentally friendly in that I never leave the front door, let alone get in the car.
Nice.
I work from an office in my house, and so my commute is about 20 seconds down the stairs.
Awesome.
And I'm in a suburb called Cannon Hill. Yeah.
Very nice.
Well,
yeah, but you know, thinking back on this discussion, it really highlights this incredible benefit. And as I said, you know, if I look at it, I've got the explanatory memorandum to the bill, and it says in the opening paragraph, just bear with me while I go to its intent. This bill amends the Act to exempt from FBT the use of cars that are zero or low emissions vehicles made available to employees. The objective of these amendments is to encourage a greater take-up of electric cars by Australian road users by making electric cars more affordable and to reduce Australia's carbon emissions from the transport sectors. And that's really what it does. I mean, there's such attractive provisions. How can it be anything other than an amazing incentive to get an EV?
Yeah,
100%.
Unfortunately, not available to non-business owners, right? It's just one of those things where I say, guys, at least throw something else in for people who don't run a company.
Well, you say that, Gunnar, but what's stopping, like my example before, he's sort of a business owner, that guy, but he goes to his owner and he says, hey, someone mentioned this EV trick. Would you be willing to enter a salary sacrifice with me to do that? And the cost to the employer is in the administrative hassle of preparing fringe benefits tax returns. And maybe, just maybe, you factor that in as well and say, well, we factor that in. This is a great benefit to our employees. We're not paying anything extra other than the cost of preparing fringe benefits tax returns. The employees we've paid our employee more, and guess what? They're more willing to stay with us. So I think employees and non-business owners can take advantage of
Yeah.
this.
Totally. And I would definitely consider if someone in my team came to me and said that they wanted to do this. I would definitely be open to it.
Yeah. Paul, it's been such a pleasure. We could go on forever. Well, thank you. Thanks so much for your time. I really enjoyed this. This was so much fun. As much fun as you can have talking to. Hey, look, we talk to lawyers, and I'm always thinking. Usually, when you talk to lawyers, you don't have fun, right? Because why would you otherwise talk to a lawyer?
Is that the reason it's fun? It's probably fun because it means there's more money in your pocket, and everyone loves that.
James, got any final things to say?
No, that was great, Paul. Thanks for the explanation, mate. That was super helpful.
No, really good to chat and great to talk about these terrific benefits and I look forward to talking to you guys, but also listening to the podcast. So great
No
work.
worries. If someone wants to get a hold of you and says like, this guy's got to be my accountant, how do they get a hold
Yeah.
of you?
Email. I've got a Gmail account there, and you can add that onto the link if you want. Yep.
Good on
Thank
you,
you so
Paul.
much. Bye.
See you guys.